Adobe just had one of its worst months in a long time, and the market reaction is sending a very clear message. Because if you only look at the headline numbers, this quarter actually looked strong. Adobe reported around $6.4 billion in revenue, growing at a double-digit pace year over year. Earnings per share also grew solidly, operating margins remained extremely high, and the company generated record operating cash flow. Total recurring revenue reached more than $26 billion, showing that Adobe's subscription engine is still powerful and highly profitable. Even more importantly, Adobe highlighted that ARR from its AI-first offerings more than tripled year over year, which confirms that the company is successfully positioning itself in the next wave of creative technology. So at first glance, nothing here looks catastrophic. But the market was not reacting to what already happened. The market was reacting to what might happen next. During the earnings call, management clearly admitted that Adobe's traditional stock image business declined faster than expected. This is not just a small side segment. This is still a meaningful revenue stream worth roughly hundreds of millions annually. And the key issue is timing. Adobe is trying to replace legacy stock content revenue with AI-generated content solutions. But that transition is happening faster on the downside than on the upside. In simple terms, old revenue is falling faster than new AI revenue is fully monetizing. At the same time, Adobe's AI usage metrics are exploding. Firefly AI is seeing rapid adoption. Generative credit usage is growing quickly. Video and audio AI generation activity is accelerating. Creative freemium users have surged dramatically. And total monthly active users across Creative Cloud, Acrobat, Express, and Firefly have now surpassed 850 million people globally. This shows something very important. Demand for AI creative tools is real. Adobe still has one of the strongest ecosystems in digital creativity. But management also explained that this freemium strategy creates a short-term financial lag. Users enter the ecosystem, experiment with AI tools, and only later convert into paying subscribers. So right now, Adobe is in what investors call a phase shift period. Strong user growth today, delayed revenue impact tomorrow. And then there is the second major headline that investors are still processing. Longtime CEO Shantanu Narayen announced he plans to step down after nearly 2 decades leading the company. This is a huge moment for Adobe. He helped transform Adobe from a traditional software company into a subscription-driven SaaS powerhouse with industry-leading margins and dominant market share in creative tools. Leadership transitions always bring uncertainty, but they can also create opportunity. A new CEO could accelerate Adobe's AI strategy, push more aggressive innovation, optimize capital allocation, and potentially unlock a new growth narrative that re-energizes the stock. So while some investors may see risk, others may see this as a strategic reset that could benefit Adobe long-term. Now, let's talk about valuation, because this is where the story becomes really interesting. After the recent sell-off, Adobe is trading closer to historically low valuation levels relative to its long-term multiples. That does not automatically make it a buy, but it does make it worth paying attention to. Because if Adobe successfully proves that AI can become a major revenue engine, not just a usage story, then today's price could eventually look very attractive in hindsight. At the same time, this is still a transition story. The company needs to show that Firefly, Acrobat AI, Express, and Enterprise AI solutions can scale revenue fast enough to fully offset the decline in legacy businesses like stock content. Until investors see consistent proof of that monetization curve improving, the stock may continue to trade with volatility. So from an investment perspective, this looks like one of those high-quality but uncertain situations. The fundamentals are still strong. Margins are still elite. Enterprise demand remains healthy. AI adoption trends are clearly positive. But the market is waiting for execution. Personally, this is the kind of setup where patience makes sense. Adobe is starting to look attractive from a long-term perspective, but it may still need time to prove that the AI transition is working financially. So, rather than rushing in, this could be a moment to watch closely, stay disciplined, and wait for confirmation. Because if Adobe executes well in the AI era, this period of weakness could eventually turn into a major opportunity. But if the transition takes longer than expected, the stock could remain under pressure. And that is exactly why Adobe is such an interesting company to follow right now. Thanks for watching, and I will see you in the next one.